What's up guys, welcome back to G-Tech Finance. So I feel like it's time we address something that probably a lot of us have recently considered, and that would be the next stock market crash. After all, in the last week, the stock market has risen to brand new all-time highs, interest have just started increasing, and across the world measured, the stock market is the most expensive it's ever been in history, and even the search term stock market bubble has increased 100% to its highest level since 2004. Meaning that people are now more than ever concerned that prices are rising too much and too fast. Given all the nervousness around this, let's talk about exactly what's going on, the likelihood of another crash coming sometime, and then what you could do about it. That you're best prepare ahead of time and you can make the most of the situation, because I promise you at some point the market is going to crash again. There's going to be another bear market, there's going to be another small recession, and even though we can't time it perfectly, we can always do some stuff to not being caught off guard and to make buttloads of money to and this is probably going to be a video that is going to be about making money in the stock market crash. So according to data, what we're going to see is usually called the stock market correction, which is defined as at least a 10% drop in price. Now, normal volatility throughout the markets is extremely common. In fact, since 1920, the S&P 500 has on average seen a 5% pullback 3 times per year. So next time you see the markets down like this for a week straight, it happens on a regular basis and it's nothing to be concerned with. Market corrections are also fairly common too. On average, a 10% correction happens every 16 months. And throughout the last 20 years, a 10% drop has happened 11 times. After that, we move on to the more serious category, the bear market, which is defined as a drop of at least 20%. According to data, this typically occurs 7 to 10 years. And when it does, it hits hard. During a bear market, the stock market drops an average of 33.18%, and it falls over a period of 363 days. Now, it's important to remember that these are averages, and just because it's been this way in history doesn't mean it will always be like this, or the next drop will last an entire year. And finally, we have the big one, the stock market collapse. I'll consider this a drop of over 40% throughout the entire market, not just one specific area, and throughout the last 120 years, this has only happened 3 times. Once in the world crisis of 1929, again during the 1979s, and in the world crisis of 2009. So an actual stock market collapse is rather uncommon, but not impossible to happen again in our lifetime. Now, what can we do about it? First thing is always keep a 3 to 6 month fund at all times. Now, I know this might sound like a broken record when you say this, but it's true. Having a 3 to 6 month worth of your expenses saved up in cash at all times is one of the easiest things you can do to make sure that you'll last through the stock market drop. Second one, and I think everyone knows it, is diversify your investments. The more you spread out your money, the more you reduce your risk and volatility. And this is the approach that a lot of people have taken. Number 3, keep buying in. Study after study show that the best thing you can do is just stick to your plan, keep buying and hold, never sell. If it goes down, buy at a lower price. It will eventually go higher when things come back to normal and the crisis is done. And you'll end up making profits. Number 4, don't panic sell. So this is a psychology that a lot of people can't bear with, is when their investment goes down, they sell instantly to cut off losses, which is panic selling. Now, this psychology that pushes you to sell because your investment is dropping is going to be the same psychology that will hold you back when the market starts going up again, and you'll miss on a huge opportunity. Number 5, keep a steady income. The biggest risk I see with the stock market corrections is that, depending on their underlying cause, it could also be associated with job loss or reduction in income, like we saw a lot with the illness right now. People getting laid off, unemployment rate over 10%. We have videos about it, that's not a problem. Number 6, keep more cash. So statistically, this is not what you should be doing because the dollar loses in value due to inflation every day. And so this is not the best thing to do. But more often than not, investing your money all at once in the market will yield the best results. But if you want to play it extra safe, keeping more cash on the sidelines is a way to do that. Like this, if you see this huge investment opportunity and you don't want to miss on it, you just have the cash that's ready and you go as quick as you can. You poach it and you're done. Number 7, if you need this money in 3 to 5 years, it's probably not a good idea to invest in stocks. So a few years is not long enough to ensure that you'll actually make money. So the shorter your investment time frame is, the less likely you should be invested in something that could drop in price. Ideally, you should view this as a 10 to 20 year long investment, or even longer, but not less. The reality is, if you can do the above, you're practically guaranteed to make money over a 20-year time frame, regardless of what market does in short term. I say this really confidently because in the entire history of the stock market, a 20-year holding period has never even once produced a negative result. That's it for today. I think we're gonna stop here. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already. We're trying to reach 20 subscribers and hope to see you guys next time.